All right, this is going to be recorded, and one thing I mentioned is watch this as soon as we get it sent off to you in an email. First time through, some of this stuff may go by you rather quickly, especially if you're new to options. Second time through, it will solidify it into your long-term memory, so it won't be as difficult to implement this strategy. If you wait a couple months down the road, you're going to be learning it pretty much all over again. So just keep that in mind. I know last week we had a bit of an issue with our uploading of that video right away, but hopefully that issue isn't still in existence. Anyway, this is going to be on long straddles. And before I get into a whole lot of about the long straddle, I got a couple of things to go over. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical market analysis. I actually started trading in college with some money I had earned. I started out with a psychology degree and then started trading, realized that I really wanted to do that for a living. Did it say, this is on Strangles, Long Strangles. Anyway, so I switched over my degree to finance, and then after graduating, I moved to Chicago to work at the Board of Trade to trade on the floor. And in that time, I've traded everything, from stocks, financial futures, commodities, currencies, and options on all these products in all market conditions. Welcome back, ER. Nice to see you. Anyway, I got to get this out of the way. Any opinions, news, research, and analysis, or other information contained here is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically, what we're saying here, you guys, is I don't know your risk parameters. I don't know what's in your portfolios, and it's up to you to really determine whether or not these strategies may be appropriate for you, and or whether the underlying is appropriate for your portfolio. You may have something in there where what we're talking about is counterintuitive to what you're already doing. So, and another thing is I may very well have some of these underlyings in my portfolio, and I'm not trying to get you to lemming off the cliff with me, which is what we used to say on the floor, just to follow the leader, which some people out there do. I'm actually here to teach you how to swim and not really swim for you. So keep that in mind. I think it's more important to say teach you how to fish or teach you how to swim. Some people just say, hey, this is the trade of the week, jump on board, and that's really not in your best interest and or the best interest of this market. So anyway, the bottom line is do your own homework. Remember, past performance of any trading system or methodology is not necessarily indicative of future results. Another thing to go about, you can follow us on Twitter. I'm at Wolfman's blog. That's my Twitter handle. And Pro Trader Strategies is at Pro Trader Strat. So you can follow us for all kinds of good fodder. Hopefully, anyway, it's educational for you. Especially for me, I usually will throw out what my earnings trades are on Twitter, so you can follow that and just general market snark. And this is how to trade long strangles. Last week we did how to trade short strangles. This week we're going to be doing how to trade long strangles. And one thing to set this up, basically we're buying an out-of-the-money put and an out-of-the-money call. And keep in mind, these are both out of the money. If these were both in the money, it's called something, it's called a gut, is what we called it on the floor. And that's not what we're going to be talking about. I don't like that strategy at all, the gut, that is. And strangle is one of these long strangles. Before we go a whole lot further, keep in mind, I don't implement this strategy a lot. Do have a sector that I actually like to implement this around if I'm going to, but for the most part, I want to go over the good and the bad with you with this, because that is really important with a long strangle. It is a low probability trade, but with that low probability trade, there is a high profit potential. but we need to have a big move happen relatively soon after putting on this strategy. So that's why I was talking about a particular sector of the market that would be the one that is my favorite to put this around. But keep in mind, if you are, Francis, this will be archived for sure. Keep in mind that if you're going to implement this strategy, it is a low probability strategy, and in that, when I do it, it's usually to keep me involved in a way. I'm not thinking I'm going to get a home run with this strategy, which is this is swinging for the home run type strategy. It is more to keep me engaged in the market and keep me active in it. So keep that in mind. My bread and butter is selling option strategies in high implied volatility in market, in high implied volatility percent type scenarios. This one is going to be in a low IV environment. So, and I'll go through all that in a minute. This is basically what we're looking at, a typical setup using Oracle. This was pulled off today. And as you can see, you know, right here is where we implement this strategy. So it is a loser off the bat. So we need to have a pretty big move in either direction to get above break even, to get into the profit zone. So, but as you can see, if I were to have squished this down, it will continue in both directions, all the way down to 0 for the puts and, you know, to infinity and beyond on the top. So a couple of things to go over real quick. Essentials to success. If you guys have watched these videos before, you know I always go through these. And this is the process that I go through to make sure that I'm following my rules, staying mechanical, and making sure that when we implement a strategy, we have covered all our bases. And picking the right strikes with this one, I'm looking at a strike that is, like, I think I mentioned this, around the 30-ish delta. The reason why I want to pick a 30-ish delta and not like what I talk about when I'm selling option strategies, because I want a high probability of this going into the money. We want this to go into the money and even a little further, because remember, since we're paying a debit, our break evens are a little bit higher than our calls and a little bit lower than our puts. So we need to have that extend out even a little further. That's right. Yes, we need rules. And follow your rules, you guys. When I throw out these rules, put them down and follow them. Be mechanical about it. Don't let that emotion get in the way of your trading. That was one of the things when I moved to Chicago and was working on the floor, I was like, I think that my psychology degree is more beneficial to me in trading than it is my financial degree, because the emotions that you have to, you know, for one, it was on the floor so you could see everybody else's capitulation points and things like that, but you don't get that anymore on the screen. But it's really to handle your own emotions, and the way to do that is to follow the rules, stay mechanical, and don't allow yourself to second guess what's going on. 30-ish delta is about a half standard deviation. That is exactly right, John. A 30-ish delta is wrapped around a half standard deviation, and it only has a 30% probability of being in the money at expiration, but given that, it also has about a 60% chance probability of being tested or touched. So we do have a high probability of being tested on this, and that's what we're looking for. That's why I'm picking a higher delta. We have to pay a little bit more money for it, but we're trying to get to our probabilities of success here. Picking the right duration. Now, usually you guys know I'm talking about this particular slope here. We want to stay out of this pretty much, but the further out we go on this, we do have less time decay, which is going to eat those premiums, or eat away, erode, I should say, at the premium that we paid for. But and it gives us a lot longer time to be right, but you're also paying a lot of money, laying out a lot of money. I usually try to look right around in this area, somewhere between 60 and 50 days to implement this strategy, because remember, we're looking at this strategy as soon as we implement it. We're looking for a big move, and if we don't get that big move right away, we're going to be looking to pull the ripcord rather quickly on this strategy going forward. Is this similar to an iron condor without the other half? Francis, yes, in a sense it is. An iron condor in any regard is like a strangle, but with extra wings to it, if you will. When we're doing a short strangle, it is a defining that risk. You could look at this long strangle and try and sell something against it, but at the end of the day, when you're doing a long strangle, it's a defined risk strategy, and because you have to, in order to sell something outside of where you break even to really make it cost effective, it's almost better to do this without selling a call and a put to help finance some of that. You're just not going to get enough money for selling those out of the money ones, and at the end of the day, it's increasing your commission costs and everything else. So with this one, I just kind of like to throw it in there. But one thing to keep in mind, if you guys are used to doing 10 lots and selling premium and stuff like that, look at this one where we're doing one or two lots, and if you do 5 lots normally selling premium, do it as a 1 lot, like a fifth of what you normally do on your contract size, just because it is such a low probability trade, and it will make up for it if you get that move, and it won't hurt you as bad if you don't get that move, and you usually are not going to get that move. All right, so keep that in mind. This is a low probability trade. I don't think I can emphasize that enough. All right, so picking the right environment. Now, we want something that has low implied volatility. Right now, we're heading into earnings season. I know that's top of mind for everybody, and a lot of questions I want to answer before maybe we even get there on this one. I would not implement this strategy for an earnings event, being if you do it a month or two ahead of time, or 3 weeks ahead of time, a couple weeks ahead of time, cover it before that earnings event, you guys. Like even if it's the day of the earnings event, if the earnings were coming out in the afternoon, cover it before that earnings event happens, because yes, you might get that big move that you're looking for, but that theta decay or the volatility coming out has held up theta decay, and it's going to suck the premium. They're going to just deflate. It's like a big balloon losing all its air, and you could be directionally right with this strategy, but you're going to get crushed with volatility coming in. All right, so keep that in mind. If you do implement this heading into earnings, then make sure you have enough time to capture the expansion in volatility, because that's really what we want in this, is volatility to expand afterwards. A big move maybe in there as well would really be great, but volatility we want to expand, not contract, because that will ultimately hurt us. So if you have this on going into an earnings event, cover it before the release of that event, because volatility will come out of it, and you could be directionally right and watch all your profits go by the wayside. So picking the right environment, we want low implied volatility. Usually I talk about high implied volatility being above 50%. You could look at this as we want implied volatility to even be below maybe 30% for the most part before we start implementing the strategy, because when we have low implied volatility, for one, it allows us to get closer to the market, closer to where the underlying is trading, and that will increase your success rate. If you do this in a high implied volatility market, you're going to be a lot further away from where the underlying is trading, and that means you have that much more distance to make up. So we want to have as little distance as we have to and have, this move rather quickly, and we will be more successful, increase our chances of success. Picking the right underlying, this goes for all of my strategies. Make sure that if the underlying is trading at $100 or less, that bid ask is no more than 10 cents wide. If it goes out to 25 cents, if it's a $300 stock and it's 25 cents wide, then that's okay. But anytime you're trading with a stock that's under $100, make sure that bid ask is within 10 cents. I mean, you can have like Apple trading at a penny wide, and that's a $100 stock. So those are what I'm talking about, picking the right underlying, high volume and open interest, to make sure that you're not having to give up the edge on either way. And with this one, if we want volatility to expand, that means that we are seeing a lot of movement happening right away. And when there's a lot of movement going on, I can guarantee you the bid ask is going to get a little wider. So if it started out where it was like 25, 50 cents wide on your bid ask, when it starts getting crazy, that bid ask is going to go to 50 cents to $1 possibly. So people aren't willing to give up the edge in a high risk environment. So keep that in mind. You want a tight bid ask, so when the going gets tough, there's always somebody in there willing to give up a bit of an edge to get in or get out, all right? So make sure that there's a lot of volume and open interest in any underlying you're ever trading, for that matter. And know your exit strategy before entering your trade. Now, with this one of my rules of thumb with this is that we are going to be looking to take about a 50% increase in our profit. So what does that mean? If we pay $1 for this strategy, when this strategy is trading, when I've made it's trading for $1.50, I've made that 50 cents, that's 50%, all right? That's when I'm really looking to cover this strategy. Also, on the flip side, to get out, if it's going against us, it's just trading, or not going against us, but it's not performing the way we want, meaning it's trading sideways, and we're just watching theta decay happening. I usually will look to cover this at around a 50% loss. So, when it's trading at 50 cents, that's when I'm going to be looking to cover this. So it's basically a risk one to make one in a sense. And when we're playing with that 30-ish delta, keep in mind, it's a 30% chance of being in the money at expiration. I'm not looking to take it that far, but there's a 60% chance that we'll be tested on at least our strikes that we're along, either one side or the other. So this is a little bit of a chart. I got some good feedback on having something like this just to kind of keep you a little bit more mechanical. And in 10 days, if you gain 20 cents on this strategy from $1 to $1.20, I'm probably going to be pretty amped up to cover this within just 10 days. But at 50 days or 50% profit, I'm covering it. As I have all these extra days in there, I'm covering this. Just because it's such a low probability trade, you need to get in and get out of this trade rather quickly. So anytime is trading less, you've been in this trade less than 10 days, you're at 20% profit. 15 days, you're at 30% profit. 20 days, you're at 40% profit. Seriously, look to cover this, because that theta decay is going to start hurting, and especially 25 days, that you're in that slope of theta decay where it's going to start ramping up on you and start eating away at your profits. All right, so keep this in mind. I know that you're probably thinking, is it worth putting on this strategy for only a 20-cent gain? Well, that's for you to decide. To me, I look at it like, hey, that's, after commissions, that's probably 15% more than I had before. So I'm willing to take that. It's a 15% winner. You guys would take a 15% profit anytime, right? So look at it that way. It's a low probability trade. You have to be looking to accept a little bit less profit in my eyes on something like this. And if it happens really quickly, then, you know, seriously, cover it as quick as you can. All right, so our max profit on something like this is unlimited. That's because to the upside, this could go to infinity and beyond. The likelihood of that happening is slim and none, and Slim just left town. But keep in mind that that's what the risk parameters are, and or it going to zero, but that likelihood is pretty small as well. Francis, anytime 20% profit on a trade, I'll take it. Yep, I agree with you. It's not a bad, especially when you're buying. Mark says, I do these quite a lot. Technical points, if bullish, slightly skew my delta on the calls. Long GS. All right. 9:30:10. Had the November expiration. Thoughts if possible. Mark, let's go. We'll go over that when we when I pull up the platform. All right. So max loss. Anytime you pay a debit for a spread, that is your max loss. All right. So just keep that in mind. You know what your risk is getting into this, and so you can deal with that appropriately. And then our break even is going to be our long call strike plus the premium we paid. Now, if we're short the 55, or sorry, if we're long the 55 calls and we paid $1 for this, it has to go up to 56 in order for us to be at our break even. Same thing if we're long the 45 puts and we paid $1, it needs to go below $44 in order for us to be profitable. Okay. So let's pull up the platform here and get into it. And this is usually where I talk to you guys about throwing out some underlines that you guys like to look at, and we'll go over it and go through the steps here and see if it fits the parameter. I don't even have to really look at Goldman, but just as a so we want to be outside the 56 or 50 days. 56 is pretty close to it. 91 days, we would be paying a lot for that 30-ish delta. Like, you know, we're paying $10, which I don't like to do necessarily. So I don't like to pay a lot for my options. So Goldman, right here, this is the 30-ish delta. We could go rather close to it to increase our probabilities of being in the money. But I usually like to try and pick somewhere around that 30 delta. I will round up, you know, if I need to, but that's, you know, that's quite a ways. That would be more of looking at like doing a straddle, which I don't want to go into right now. So with this one, we're going to be, oh, I'm sure they don't have high implied volatility because they just had their, 1% implied volatility. So that's below 50, obviously. And so we'll go look out at the December to give us enough time to be right. And, oh, I must have been looking at the wrong month. So, so this is the 30th, so the 80s. So what we're looking at buying. And then the 30s down here, the 70s is where we're going to be looking to buy. Hopefully. Did I not? Oh, I held down the wrong button. Sorry. I usually build these out. You can go up here and pick like the straddle, the strangle, and stuff like that. I always like to build it out myself. I don't like the structure they usually give you. So I usually just go to buy one, hold down control, and click on the buy on the other one, and it builds that out for you. And it knows you're doing a strangle. So that's how I usually do it. So $6.61. So on the put side, it needs to go down to 73.39 in order to get to our break even, and it has to go to 86.61. So one thing you can do is go back and look at this, just because a lot of people look at charts for sure, and you can see that this strangle probably would have worked out had somebody put the strangle on at maybe even the beginning of the month, and had that much of a move. That was well over a $5 move to the upside. So that would have been a profitable strangle had you entered that. Even here probably would have been a profitable strangle, minus all the theta decay and everything else. But so we're at the beginning of the month. We don't have an earnings trade. We got low implied volatility. One thing to keep in mind is the dividends. Dividends will affect your call premiums. So at the exit dividend date, if you are trading very near your break even, you guys, and you're heading into an ex-dividend, I'd probably even look to cover that because it's going to drop in value. Those calls are going to drop in value by the dividend, or it's going to be very close to that because the stock is going to drop in value by the amount dividend paid on the ex-dividend date. All right. If it's down around my puts, I'm probably not going to worry about it as much, but something to keep in mind on the dividends, then you need to keep that in mind. All right, so back to the trade. All right, so Mark said he bought them on September 30th and again on 10/13. Is that November 13th, November 14th? If you're buying, don't you want a lot of volatility? No. Anytime you're buying options, you don't want the volatility because the idea is with volatility, even with this, you can see volatility has a tendency to revert back to the mean rather quickly. It takes usually a little bit longer to expand on you than it does to drop. We want these premiums to go up, and volatility pumps up those premiums. If you were to buy something like an option here or even here, that in just a matter of a couple of days, that volatility coming out sucks out your premium. That's called volatility crush, and that will hurt you. So you want to buy it when it's down here because the idea is when it's as low as 1% that means it is at its lows. It's not to say it can't continue to go lower necessarily, but the probability is it's going to revert back to the mean or close to 50%. So when you buy it down here, you have a higher likelihood of it expanding for you, and that's what we want because then we can have this not really, it will bring in our break even, if you will, a little bit quicker, or our potential for profit. As those premiums expand, then we're making money. But as those premiums contract or go down, then we're losing money rather quickly. And you could even be directionally right in a situation like this, and if you had bought it, all of that premium coming out of those on the even correct directional move, which I can show you on maybe a different trade, that you would not be profitable. You could get the directionality right and everything else, but as those premiums deflate so fast, you won't even be able to be profitable. So that's why we wouldn't want to do that. All right, so back to this trade. So we can even look at it on the Analyze tab. Go to the Analyze, and it will show you very close to what I was saying, to the upside. That line is going to be right there at the 61, 63, or sorry, 80, 86, 61, 63 to the upside, and to the downside. That's with probably the, could be with the, I don't know why it's off a little bit other than it would be with the commissions added into it to the downside. So as you can see, you're increased in profitability to the downside, and once you get above, it is unlimited to the upside. All right, and then we can go back and say, so we got to get to 86 and 63. So to 86 to the upside, it needs to get up to here for us to be profitable, and the 63 is right here. Now, one could easily say, We have FOMC coming up, and that could increase volatility for these, and depending on what the FOMC does, could get Goldman Sachs really juking back and forth, which is good. So that's something that doesn't seem to be priced in for the volatility, is the FOMC coming up. So that could create a lot more volatility, and that's why you're seeing these volatility spikes off of the earnings for Goldman, is because that's usually right around where those FOMCs are. So that would be a good trade, actually, to see some volatility expand rather quickly. That makes sense. What was this? On Strangles, aren't you always going to be right when it goes in any direction, up or down, in extremes? Absolutely. So this is a situation where, just like with Goldman Sachs, okay, so we don't know what directionality, this is where we don't really have a directional assumption, but we can be looking at Goldman Sachs and saying, okay, there's an FOMC coming up. That's going to, as a matter of fact, we might even be able to capture 2 FOMCs with this. That's going to create volatility in and around this. And if they raise rates, that's good for Goldman Sachs, because then they get more money from their idle funds. And if they don't raise rates, that's going to hurt them. So, that will make them pull down. So that could create a big move just on that whole scenario. So that's what we want. We want something where there's not a lot of volatility, but we could foresee something coming out. That's why when I was talking about a sector that I like, especially right now, one of them is the banks. The other one is my favorite to put this strategy around, is the biotech sector, because they can come out at any time and say something, well, we had a test that went bad on a particular, not thinking of the right word right now, but on a particular drug. The trial didn't go well, so that could really make the market move quite a bit. We saw what happened with Mylan with the EpiPens, so that would have been something around those. So those guys have a tendency to trade with low volatility, but have volatility happen rather quickly, and you have an increased chance of winning with those. So biotech being my favorite. Unfortunately, we have biotech coming up in the next couple of weeks for all their earnings, so it's not really going to work out. But for instance, so actually, having said that, I think what is it? We could look at, let's just look at Amgen or Gilead. Let's look at Amgen, because it's above 50, just for this example here. When is Amgen's? On the 14th, 11/14, so it's a couple weeks away yet. But still already increasing volatility. So with what I was talking about with this, so for instance, we bought this 30-ish delta right here and the 30 delta here, so we're paying $6 almost, $5.75. What you can do is look at this and go into the theoretical price. Right now, it's got 50% IV percent, but let's look at it like we go to that earnings date, which is the 14th, I think I said, and we've got that long to go, and the price adjusts by, if we had bought these, so add in $5, it goes to $72. So $72 onto, that's about, it increases by $15. Is that about right? So let's just say it increases by $15. So that puts us very close to our break even, just for, ballparking anyway. The result is $15 stock price adjustment. Why isn't that? Anyway, there we go. So after that time, you can see that our prices increased there quite a bit, But let's look at what happens. That's if volatility remained the same. But after that earnings event, let's say we got a decrease of, you know, it was at 50, so we could say it goes down to 10, so we lose 40% on that trade there. We can see that these, and you know, that's real close. It would have been slightly profitable on that. So we originally paid $6.50. We would have made some money on that. But a lot of times what you could see is that you were directionally right and not made the money. If it was like maybe $14, I think I went $1 into the money on that. So let's just say what $14 is. You know, then we would have been very close to break even on that trade. So does that make sense? So that's why we don't want to do it in a high implied volatility environment and have that volatility come out, because we can be directionally right. We're just fighting an uphill battle. We got that to go to basically our, or at least very close to our break even, and it still would be costing us. So we would rather see something like this where, let's say, you know, it only went up $10. Market goes up $10, still doesn't really get to our break even, but we see the volatility expand for us. And as you can see, that's a dramatic difference. You want the volatility to expand for that very reason, and it helps obviously to get the market to go in your direction. So what would happen? So even if you just get the market to expand, the volatility to expand a lot, then we're profitable even though it didn't even move. Okay? See how that works, you guys? That's why it's really important to get us to have expansion in volatility. And the only way to really do that is to implement it. The only way to increase your probabilities of that is to have volatility low at the onset. Okay. Did anybody else, I know I had a lot of questions rolling on here. Did anybody else have any stocks that they wanted me to look at? I thought I saw one, SKT. So let's get rid of that. So was it Mark? Did I cover your question on Goldman? I mean, I like the situation that we're set up for that. Oh, somebody likes playing with the big dog with Priceline. So Tanger, I've never even traded this stock, to be quite honest, but this is what I'm talking about with, you know, $36 stock, and it's zero bid at 35. Let me go back to the gamma and the deltas. There's just, and it's got a higher implied volatility percent. I don't know if they have earnings coming up or whatever, but this is something I wouldn't want to get into, because if I buy these, for one, I'm having to give up so much edge, 35 cents for a $35 stock. To get out, there's no bid in there. I mean, there's just nobody wanting to play in, from what I can see. Volume and open interest, I mean, zero volume in there at all today, and almost no open interest. That means when things start hitting the fan, everybody's running to their Apples, their Pricelines, their Netflix, and getting out of those because they're easy to get out of. They're just, you're going to be stuck in this, from what I can tell. All right. All right, so let's go on to Priceline. Now, obviously, with this one, you're going to need to have deep pockets. I'm not going to go to all because I don't need that many, because for the deltas, I don't think I'll need that many. I guess I will. So let's go to 30. So for this one, I would probably, you know, for sure play in a one lot, but you know, this would be where I would really go to the high 30s, because you get that choice and you're really not paying that much more for the mid 30s to that one. Oh, you are kind of paying a lot. But so keep in mind with this one, you know, Priceline's a little bit different. You know, we're talking about a $1,400 stock here, you guys. So you're going to be paying a lot. And then the 30, I'd probably lean towards the 39s just to increase my chances here. Why didn't I? Right? So you're paying $87. So to the upside, we need to have this go to 1607 on the upside. So 1607 is another $100 higher. Now, I mean, Priceline does move, but, you know, in that course of a month, I mean, I suppose you could. It went from 1400 to that, but that's a pretty big move. And you did have this big move there. I mean, it wouldn't be good for me, but it's not to say that, you know, it'd have to go to almost 1400 to 1600. 1400, I mean, it's right in the middle there, but I don't know. That would maybe be one that I would not do. I'd probably almost rather go out and sell it. Plus, I think that it looks like the IV, oh, they got to have earnings coming up pretty soon. The IV percent's probably pretty high. Yeah, it's up above 50. And when's their earnings? Yeah, they got earnings on like the 7th. So that would be something I wouldn't do. I mean, you could, because you know the earnings is coming up, but you need to have a big move before that. And if you are going to do it, cover it well before that earnings trade. You're just looking for vol expansion on that, and you're probably not even looking at taking 20% profit on that trade in this regard. You're trying to play this for a volatility expansion type trade. All right, the other one, Netflix. Netflix always seems to want to jump around. As a matter of fact, they just had their earnings, and you know, so this is something I was looking at for even like McDonald's and a couple of other ones, Microsoft, to do a similar situation with this, because it seems like, okay, so I don't know if you all have kids, but these kids seem to be moving away from like the PlayStations and things like that and moving back to the home computer, the PC. So we're seeing a lot of these like Adobe's and Intel and Microsoft kind of coming back because they're starting to see a lot more PC sales. People are buying those gaming computers for like $2,000. So they're starting to capture some of that. So the PC may not necessarily be dead. So this was a situation like where you could have put this on afterwards and gotten that right after that volatility crush, and you're starting to get that expansion plus the move. So this was something I wanted to bring up and add it as a talking point, was sometimes this is good to put it right after that volatility crush. You could go a little further out in time, capture the next earnings cycle, and knowing that if you look at Priceline here, traded sideways, the volatility did go down, but then for the entire time up into that event, it had a rise in volatility, and it has a tendency to do that a lot of times. Here it didn't so much, but heading into that earnings event, you see the volatility increasing. So this would be one that would be a good one for that, but their premiums are usually pretty high too. All right, so the 30-ish, so I would probably, you know, this is kind of a pick 'em on there. You know, this gets a little bit further away. You're increasing your probability of success though when you're paying a little bit more for $1.50. So I would probably look to, in that regard, I'd like the closer to the 30, but I'll go with this one for sake of argument, because I have a feeling it could easily move back. I mean, we could easily see that retrace back down and get it. I'm going to change that number. I'm not superstitious. All right, so basically we have to go to $47, let's just say, for ballparking purposes, and we have to go to 13 to the downside. So We need it to come back down below this fib level, and you know, you can easily see that, what was it, $6? I mean, it probably had a $6 move almost today. It was up $4. So, you know, in just a couple of days, that would have been a profitable trade. So perfect scenario for something like that. So with that, let's look at Microsoft, because Microsoft's, as you can see, volatility has come off. They beat earnings. So a couple of scenarios around this. You know, could we see this retrace, cover this gap, or see the shorts get scared? Now keep in mind, this is a historical high for Microsoft. I think the last time it was up looking at $60 was in 1999. All right. So there could be a lot of people wanting to cover in that regard. So just having that historical high. So let's look at it. It's got pretty low implied volatility on that, 18%. So we can get rather close to it. It doesn't have that 30 delta is the problem on that side. So we could be looking at buying 57.5s and the 60s, which we'll have to end up paying up a little bit for. But I'm all right with it. All right, so but that's not what I wanted to do. I wanted to do this one. So let's look at this on the Analyze tab. So again, we have the break even to $62.09 to the upside, and to the downside, we've got to get it down to $55. Should be $55 or very close to it. And then, so $62 the upside, there's nothing on the upside there. We could probably look at a Fibonacci extension if you like to look at those to see where that could go to the upside. And then the $55 would be to be coming back down into this range again. So, you know, we could play it that way, and then far enough out to where we hopefully get some volatility expansion going forward. Well, what were some of these? So everybody's throwing some questions out. Basically, the system can only be profitable when it goes in the direction or stays in the direction with no movement. You would lose all your money. Yes, Francis. And that's why this is not one of my favorite. It's probably one of my least favorite. There has to be the right scenario. That's why I like to pick those. The only time I probably ever implement this is really around the biotech, because you can get that unforeseen big move. So I want to preface, this is, I can probably count in the last year how many times I use this strategy on one hand. Very rarely do I do it. It's really a engagement tool when we have had low implied volatility, you know, and or you have an assumption there's a big move coming, or you feel like there's maybe an announcement coming out, kind of like those FOMC things that I was talking about, and you could see a big move. You don't know what the FOMC is going to do. That would be the only, you really got to weigh your risk reward on this, and you do have to have a big move, and you have to have it happen rather quickly. And with a big move, you will usually get that volatility expansion, which will help you, but it's also a very low probability trade. You have to have a lot of things going for you. And then thanks for looking at Priceline. Would you do this as a pre-earnings play? So I would do it as a pre-earnings play, maybe several weeks ahead of it, maybe even 2 or 3 weeks ahead of it, but I would not hold this through the event. I would be out of this before I hear the announcement, for sure, because that volatility crush, like you see here, is going to take away all your profits. So don't hold it through the event. It doesn't, I don't care, even if you're losing money on it, don't hold it through the event, because you're going to lose more money on it, unless it's, you know, worth zero or something. All right. Why can you not open an account and use the platform when living in Spain? Oh, I don't know. It may have to do with your rules of your own governance. I don't know what the rules are with that. Sorry. I've done well with these, but not the mainstay strategy for sure. Thank you for adding, Mark. Yeah, I mean, I can't say that I've been really profitable with these. It seems like you're making money when you make, one out of 3 of these. You see, it seems like it gets you back to at least break even. But like I said, this is a rare occurrence that I'll put these on just because it's a low probability trade. Could you use it prior to earnings? Yeah, so I would, as long as the volatility is relatively low, as long as it's below 50% IV, I would. But again, get out of this before the earnings event. Because we probably could have looked at this Microsoft. I mean, Microsoft did blast off. I mean, that was very close to what the market was predicting a move. I think it was very close to $2.40, as a matter of fact, up or down. So with this strategy, you probably would have lost money had you held that, been directionally right, put it on a couple of days before, been directionally right, but that volatility that came out of those probably would have made this a loser. All right. But after the earnings announcement, isn't that when the stock will go up or down radically? Well, yes, but just like I said, that volatility coming out, usually the market maker move, more times than not, is the one that, the way to determine the market maker move is the one that it's usually inside of that. It's a rare occurrence. We've had a couple that have gone outside of it. I think, who was it that went outside of it that just had, Netflix did. Yeah, Netflix hurt me. Went outside that market maker move. But usually the underlying will stay within what the market maker move is. And if that is the case, then you are likely to lose money on this strategy if you hold it through, just because of the volatility contraction. All right? Because volatility is like a balloon, all right? If you think about a balloon and you think about the balloon being under that theta decay curve that I showed you guys, where you see that the arc go down to 0, if you think about volatility, volatility is the balloon underneath that arc. And if you blow up the balloon, it holds off theta decay, okay? It holds that, keeps that arc a little flatter. And then after, when you get that volatility come out, it's like you just let all the air out of that balloon and that curve just slams down quickly. And all of that pricing comes out almost overnight. So yes, you do get that big move like with Microsoft, but I'm telling you, I remember saying, I know what the market maker move was for Microsoft, because I tried to play it to the upside. I didn't get hit on my options yesterday. I wasn't going to chase it, but it was like rallying all day after it kind of came down here. That's when I started putting it on, because I usually put them on in the afternoon, and I wasn't willing to just chase it. And I was trying to sell a put. So, but if I had bought a straddle in that, or a strangle in that, I think you would have lost money for sure. Does anybody else have any other questions real quick? But okay, so I think I answered everybody. Broker told me not my country for Spain. I don't know. I would call TD Ameritrade and ask them. Tell them Wolfman told you to call them up and see how you can do it. Because I don't know why you would not be able to have the TD Ameritrade platform. You may have to send the money overseas to here or something like that, but I don't know why you wouldn't be able to. Do you have TD Bank over there? All right. Oh, they said no. I don't know what to tell you then. I don't know why you wouldn't be able to set up an account, but I'm not an accountant and or I don't know those laws over there that well, so, or at all, to be quite honest. But say, this is the special. We're going to do floor trader hacks for this week. It's 50% off. So for this kind of money, it will save you huge amounts, because I even talk about how to determine what that market maker move is, how to figure it out on your own, especially we're heading into earnings season. This will come in very handy for you. If you want to trade like a professional trader, a lot of this stuff has come from the floor, from years of experience that I've learned talking to other mentors and things of that nature. And remember, on the floor, we needed to be quick on our feet and know what these probabilities were. That's what trading options is, you guys, is really understanding the probabilities and implementing that into your trading regimen. You can figure out quickly what the market is pricing in for a move on the earnings. I show you how to figure that out. I show you how to figure out where to place your trades around that. I also talk about the probabilities, all 5 different ways of determining what delta is telling you in regards to probabilities. That's super important. I also talk about volatility and how it affects the premiums, how theta decay will take your money away if you're buying it. And if you want to trade like a professional trader, this is the way we did it on the floor, and it's not taught outside there in the real world, you guys. You can look all day long, you're not going to find this stuff out there, because for one, people try and keep this as secret squirrel, and the other thing is most of the traders out there have not traded on the floor. As a matter of fact, some of the stuff that I even talk about in here, I've seen Goldman Sachs give bad advice on, basically they were saying buy calls going into, like along your lines, Francis. Goldman Sachs said buy calls going into an earnings event and you'll be profitable. Well, at the end of the day, you may get the directionality right, but that they don't tell you that theta decay is going to crush you. And whenever these banks are talking, for one, you guys, I would really be cautious as to taking their advice, because for one, I don't know if it's they don't know what they're talking about, or they know exactly what they're talking about and they're trying to give you the wrong information so you jump on board and they can take advantage of it. I've been on the floor before, and I've seen a guy talking on CNBC saying, the interest rates are going to go down, and in the meantime, he was taking the other side of the market. I was holding his paper, watching him say exactly opposite of what he was doing with his position. So that, be careful of listening to those kind of people. Anyway, so all of this is going to be shortcuts. It will speed up your process on picking trades and make it more understandable as to what you're really getting involved in, and you can take advantage of it. Yeah, never listen to those guys. So anyway, this course is designed to produce consistent results. Also, another thing with this is you get unlimited access to me. So if you guys have a trade, I mean, I've been going back and forth with a lot of you, and I have a no inbox policy, where that means, like, if you guys send me an email, I'm going to respond to you, even if it's super long and we need to make a phone call. I'll call. We'll talk on the phone. So you have unlimited access to me, because I want to see you guys be successful, and I want to make sure that you guys know what you're doing when you're getting out there. At the end of the day, we can all be educated in this. The only thing you got going is the gray matter between your ears, you guys. So expand that so that you can be more successful. That's the beauty in options is we can all have difference of opinions and still make money, because there's different ways to hedge our risk and do pairs trades and everything else. At the end of the day, I want you guys to know what you're doing, for selfish reasons. I want that bid ask to get tighter. We're all in there playing back and forth together. You might be entering a trade when I'm exiting, and you could take advantage of it for the rest of the way that I didn't write it out. It doesn't mean that you're going to lose money and I have to make money. That's the beauty in options. At the end of the day, it's to create a better market. So Take advantage of this because it will save you a lot of time and money, especially in earnings season. This is going to be great for earnings season. It's really designed to help manage all of the Greeks. All right. And and the other thing that you also get my daily market commentaries where I talk about every single trade I put on, how I manage those, because remember, I have losers too, you guys. I have ones that go against me, and I talk about how I manage those. I just got done with a GDXJ trade where it went against me. I managed it back into profitability by being mechanical, and I go through all of those steps with you on what I'm doing and showing you how you have to stay mechanical. Don't allow yourself to second guess it. Once it hits a certain point, be mechanical, put your emotions to the side, and it will work out. The probabilities are the probabilities, and they will work in your favor over time. So that's why you hear me talk so much about probabilities. It's just like, some of them are going to go against you. It's just like hopefully I don't jinx the Cubs with this, but the Cubs bats went quiet for several games. And I was like, you guys, the Cubs batting averages are well below what they did all year. The probabilities are the bats are going to come alive in the next couple of games, and they're going to start doing well again. You can't discount them. Don't start talking about the GOAT again. And sure enough, the last couple of games, those bats did come alive. And some of those guys were going 3 for 3 and, 3 for 4. So basically, Rick calling me a dreamer. But the probabilities will come back. And it's just like the batting averages. That's the probability they'll get a hit. So because their batting averages are so low, those probabilities have to start working themselves back out. Rick. Anyway, it's kind of like that, though, that theory that, I had Netflix go against me, and I was like, you know what, great. That one's out of the way. Now probabilities are in my favor, and it will work out. You just have to stay active, stay mechanical. All right, and I talk about all of that in those daily market commentaries, and I talk about how to stay mechanical and how to keep your powder dry with this. And by keeping your powder dry, stay focused on what's going to get you there. All right. That's all I got for you guys today. Just want to, this link right here is in that chat box. So click on that. You can get that easily. You can just click on it. This one, there's no access to it, but this is the link that's in that chat box. So that gets you to that offer, and that gets you all of those plus several more. And future webinars, we're going to be drilling down on other trades, strategies, and when and where I find them appropriate. This, like I said, is that link that you can click on in the chat box for that special offer. And if you have any questions, you can call us at 310-598-6677 or email us at trading@protraderstrategies.com. So take advantage of that. I think there's a couple of other offers on there where you can get some access to the archives. I think somebody was asking about the archives where there's, I think there's well over 50 videos in there by now that you can get access to. And there's a couple more of these trading hacks that we've been adding too. So check those out as well. All right, if you guys don't have any more questions, I'm going to let you guys go for the weekend. I appreciate everybody sticking around for the end, and I will hopefully enjoy the baseball weekend. As long as the Cubs are up by 4 runs, I can at least stay away from the liquor cabinet. All right, guys. Thank you guys very much. Make sure you check out that offer because it will save you that amount of money for sure, and the only way to get that knowledge is to take advantage of it. All right? If you can't take that, take it easy. Thanks, guys. Take care.